15% of Florida home sales are falling apart before they close. Right now, in cities like Orlando and Jacksonville, 1 in 5 deals is dying at the last minute. The consequences? Median prices have crashed $55,000 in just 6 months, and desperate buyers are fleeing, pushed out by insurance premiums topping $7,500. HOA fees that can triple overnight, and mortgage payments now 40% higher than just a few years ago. Florida's governor is on the defensive as the housing market backlash explodes. But what's really causing this statewide meltdown? And could your city be next? The answers are more alarming than you think. Contracts across Florida are unraveling at a pace that few realtors have ever witnessed. In June 2025, nearly 15% of pending home sales statewide failed to make it to closing, a rate unmatched anywhere else in the country. In Orlando, Fort Lauderdale, and Jacksonville, the odds are even worse. 1 in 5 deals falls apart, often just days before the finish line. The numbers pulled from the state's MLS records paint a picture of a market in chaos. Buyers enter escrow expecting a routine process only to watch the deal collapse under the weight of costs that keep shifting beneath their feet. A Miami buyer describes the moment her contract died. "We had the inspection done, the loan approved, everything was ready. Then the insurance, quote, doubled overnight. Our lender said we no longer qualified. We lost our deposit." Agents echo the same refrain in city after city. In Jacksonville, more than 45% of listings have returned to the market at least once after failed contracts. In Tampa, brokers describe entire weeks where every other closing is at risk. The reasons are as varied as they are relentless: insurance premiums that spike without warning, HOA fees revealed late in the process, or mortgage rates that push monthly payments out of reach. Some buyers walk away days before closing, unwilling to shoulder a $7,500 annual insurance bill or a condo fee that suddenly doubled. Even seasoned investors are retreating. In Fort Lauderdale, institutional buyers who once snapped up entire blocks have begun pulling out of deals mid-process, citing internal risk models and the unpredictability of closing costs. Local mortgage officers report a steady drumbeat of failed fundings, with lenders now demanding proof of paid insurance premiums before releasing a single dollar. If a policy can't be bound at the last minute, the sale is dead on arrival. The scale of the fallout is historic. Statewide, more than 18,000 sales were canceled in the past year due to insurance disruptions alone. In some neighborhoods, for sale signs linger for months as homes cycle through multiple failed contracts. The uncertainty feeds a sense of panic, not just among buyers and sellers, but in city council meetings and brokerage offices where the old rules no longer apply. The message is clear. In Florida's housing market, a signed contract is no longer a guarantee. Every deal is a gamble, and the odds are getting worse by the month. Beneath the headlines, families and investors alike are learning that the real risk isn't just in falling prices. It's in deals that never close at all. As cancellation rates climb, the question shifts from how much a home is worth to whether it can be sold at any price. The fallout from these failed contracts is only beginning to ripple through Florida's fragile housing economy. By July 2025, Florida's housing market is grappling with a price correction that few predicted would be so steep or so widespread. The statewide median home price now sits at $390,000, a $55,000 drop from its peak just a year earlier. In cities like Cape Coral, Naples, and Punta Gorda, the losses are even sharper. Punta Gorda's median price has fallen more than 14% year over year, erasing the rapid gains of the pandemic boom and leaving recent buyers with homes worth tens of thousands less than their mortgage balances. Inventory tells its own story. In Orlando, Tampa, and Fort Lauderdale, the number of homes for sale has doubled or even tripled since 2022. Listings that once vanished in bidding wars now linger for months. In some neighborhoods, rows of for sale signs stretch down the block, a visible reminder of supply far outpacing demand. Local MLS data shows that in Lee County alone, active listings have surged from under 4,000 in 2022 to more than 12,000 this summer. A 200% increase. The glut isn't limited to single-family homes. Condos and townhouses, once the darlings of remote workers and retirees, are now struggling to attract offers as special assessments and soaring fees scare off buyers. For many sellers, the math is brutal. A home purchased for $445,000 in 2023 may now list for $390,000 and still attract little interest. Price reductions have become routine, with more than half of all listings in major metros seeing at least one cut before any offer comes through. Appraisers caught between falling comps and anxious sellers report that even well-maintained properties struggle to justify last year's values. The gap between what owners want and what buyers will pay is widening by the week. This flood of inventory is not just a numbers game. It reflects a growing sense of urgency and distress among homeowners. Investors who entered the market during the frenzy are offloading properties at a loss. Families facing insurance renewals or doubled HOA dues are listing homes they can no longer afford. In Miami-Dade and Broward, condo owners on fixed incomes are being forced to sell after special assessments and reserve requirements push monthly costs beyond reach. The result is a market where equity vanishes overnight and cash buyers, once rare, are now the only ones able to navigate the gauntlet of closing hurdles. Behind the headlines, the reality is clear. Florida's housing market is no longer defined by scarcity, but by a surplus that grows larger each month. For buyers, the shift means more choices and negotiating power, but also the risk that today's deal could be tomorrow's loss. For sellers, it's a race against time and falling prices. And for the state's economy, the stakes are measured not just in dollars lost, but in the growing anxiety of communities watching their home values and their financial security slip away. As the market absorbs this new flood of inventory and the $55,000 median price drop, every transaction becomes a test of what Florida real estate is really worth in 2025. The insurance line item has become the breaking point for Florida buyers. By mid-2025, the average annual premium for a single-family home in the state has soared past $7,500, more than double the national average, and up from just over $2,100 3 years ago. In coastal counties like Lee, premiums for modest homes now routinely exceed $10,000. And quotes in Miami-Dade can reach $16,000 or more depending on zip code, roof age, and proximity to water. The escalation isn't limited to the coast. Inland cities such as Orlando and Jacksonville now see average premiums above $4,000, with many buyers blindsided by last-minute increases that push their debt-to-income ratios over lender limits. Regulators point to a perfect storm. Repeated hurricane seasons, rampant claims fraud, and reinsurance costs that have doubled since 2022. The Office of Insurance Regulation's own filings show that more than 20 major carriers have exited or gone insolvent since 2018. As a result, the shrinking pool of remaining insurers passes every new cost directly to consumers. One official speaking at a closed-door summit described the market as functionally broken. No one can price risk fast enough to keep up. For would-be homeowners, the shock lands late in the process. A buyer in Tampa recounts receiving a $7,800 quote after being told to expect $3,500. In Fort Lauderdale, a young couple watched their lender rescind approval when the insurance bill jumped by $4,000 overnight. Lenders now demand proof of paid premium before funding, and title agents refuse to schedule closings without insurance binders in hand. If any detail fails, roof too old, inspection incomplete, or a carrier pulls out at the last minute, the entire deal evaporates. The pain is not evenly distributed in Lee County. Citizens Property Insurance Corporation has increased rates by over 13% just this year, with non-primary homes seeing hikes up to 50%. Even condo owners once insulated by master policies now face annual increases of 14% or more. For many, the insurance bill alone now rivals or exceeds their mortgage payment. The result is a wave of canceled contracts, lost deposits, and families priced out of homes they thought they could afford. As one state regulator summed up in a recent interview, affordability isn't just about sale price anymore. In Florida, it's about whether you can even get to the closing table. In April 2023, the state's top regulators and insurance executives gathered behind closed doors for an emergency summit in Tallahassee. The mood was tense. Only days after the meeting, several of Florida's largest private home insurers announced plans to withdraw from the state or halt new policies entirely. By the summer of 2025, more than 20 major carriers had either gone insolvent or exited the market, leaving hundreds of thousands of homeowners scrambling for coverage. The Office of Insurance Regulation's own filings show a steady drumbeat of market exits and non-renewals, with some companies citing catastrophic hurricane losses, while others blamed rampant claims fraud, especially involving roofing contractors and assignment of benefits lawsuits. The impact ripples through every corner of the housing market. Home buyers in Miami and Fort Myers described the scramble to secure last-minute coverage, only to find out their chosen carrier had stopped writing new policies days before closing. In Jacksonville, agents report that a growing share of homes are now labeled uninsurable, either because of roof age, inspection findings, or simply the lack of any willing carrier. Title companies and lenders have tightened their requirements, refusing to fund loans unless a paid-in full insurance binder is in hand. When no insurer will commit, the sale is dead, no matter the price. Citizens Property Insurance Corporation, the state's insurer of last resort, has shouldered a swelling burden. Its policy count peaked at 1.44 million in 2023, a number not seen since the aftermath of a last market crisis. Citizens' rates have climbed steadily, up over 13% for primary homes this year alone, and as much as 50% for non-primary residences. But even Citizens is now turning away some applicants, citing legislative mandates to shrink its exposure and new eligibility restrictions based on property condition and location. For condo owners, the situation is just as dire. Master policy premiums have soared, and some associations report being dropped altogether, leaving entire buildings at risk of violating mortgage covenants. Regulators acknowledge the system is buckling. In public statements, the Office of Insurance Regulation blames a toxic mix of climate risk, litigation costs, and fraud. Independent adjusters speaking on background describe intense pressure to deny or delay claims, while whistleblowers allege retaliation for reporting fraudulent activity. The result is a shrinking marketplace where risk is priced out of reach, and the basic promise of home ownership, protection from disaster, can no longer be taken for granted. As the summit's confidential minutes circulate among lawmakers, the message is clear. Florida's insurance market is contracting faster than regulators or consumers can adapt. For buyers, the question is no longer just how much insurance will cost, but whether it can be found at all. Florida's new reserve mandate lands with the force of law, not suggestion. After the Surfside collapse in 2021, lawmakers rushed to pass Senate Bill 4D, followed by Senate Bill 154, requiring every condo association in a building 3 stories or higher to complete a structural integrity reserve study known as SCR by December 31st, 2025. The CRS isn't optional. Associations must hire licensed engineers or architects to inspect roofs, load-bearing walls, plumbing, fire protection, and every major system worth more than $25,000. The findings are binding. If the study identifies a funding gap, boards are legally obligated to collect enough money to cover projected repairs over the next decade. Waiving or skimping on these reserves is now almost impossible. State law only allows a brief pause with owner approval, and even then only to address urgent safety repairs. For residents, the legal language translates to immediate financial reality. Board presidents across Miami-Dade and Broward now face packed meeting rooms and angry emails as they explain the timeline. One president reading from the state's own guidance tells owners, "We have no choice. If the ESSER says we need $1.2 million in reserves, we must start collecting monthly, quarterly, or in a lump sum before the next insurance renewal or loan approval." The deadline looms. Any building that fails to comply by the end of 2025 risks state fines, potential lawsuits, and insurance non-renewal, which can trigger mortgage defaults. The mechanics are relentless. Associations can levy ordinary dues, special assessments, or even take out loans, but every dollar must be accounted for. The Department of Business and Professional Regulation, Florida's DBPR, issues regular reminders and sample reports, making clear that noncompliance isn't just a bureaucratic hassle. It's a legal and financial threat to the entire building. Owners who bought expecting stable fees now receive notices of doubled or tripled dues with the explanation, "It's not the board's decision, it's the law." The reserve mandate doesn't just affect South Florida's oceanfront towers. Any condo or co-op with 3 or more habitable stories falls under the rule. For thousands of buyers, especially those who closed after 2022. The CERS deadline means that sticker shock is now a built-in feature of Florida home ownership. As the December 2025 cutoff approaches, the pressure on boards and owners alike is only intensifying. Owners across Florida are staring down assessment bills that would have been unthinkable just a few years ago. In Miami-Dade, Broward, and Palm Beach, condo associations have delivered notices demanding lump sums as high as $80,000 per unit, citing the legal mandate to fund reserves after the Surfside collapse. The numbers are not theoretical. One board president, voice trembling at a packed meeting, reads aloud from the Sierra's report. "We are required by law to collect $1.7 million for structural repairs and reserves. That's $48,000 per owner due within 90 days. For retirees and working families, the shock is immediate." A 72-year-old owner in Hallandale Beach describes selling her car to cover the first installment. In Fort Lauderdale, a single mother on a fixed income breaks down as she explains the choice between paying the assessment or defaulting on her mortgage. Owners who bought with the promise of stable condo fees now find themselves on the hook for special assessments that dwarf their annual income. Some associations offer payment plans, but the sums are still staggering. $15,000 upfront, then $900 a month for 5 years. For many, selling is the only way out, if a buyer can even be found. Realtors report a surge in listings from owners desperate to escape looming assessments. In older buildings, especially those constructed before 1980, the ESSE's findings are often dire. Failing roofs, corroded plumbing, concrete spalling that demands immediate repair. The cost of catching up after decades of underfunded reserves lands all at once. In one North Miami complex, more than a quarter of units hit the market after the board announced a $62,000 per unit special assessment. Many will sell at a loss, erasing years of equity and forcing owners to walk away with nothing. The emotional toll is everywhere. Board presidents field angry emails and threats of lawsuits, but their hands are tied by state law. One president tells the room, "If we don't collect, we lose insurance. If we lose insurance, the bank calls the loan. There is no option." The compounding burden, skyrocketing insurance, reserve mandates, and special assessments has turned homeownership from a source of stability into a source of fear. In the halls and elevators, Neighbors trade stories of forced sales and sleepless nights, each wondering who will be next to receive the dreaded notice. Legal threats now swirl through condo boardrooms in Broward and Miami-Dade, where accusations of self-doing and mismanagement have escalated into open conflict. In Hollandale Beach, a group of owners filed suit against their association, alleging that the board president pushed through a no-bid contract with a management firm tied to his own family. The complaint details late-night meetings, rushed approvals, and reserve funds redirected without full owner consent. In another Miami-Dade building, owners claimed the treasurer concealed the true size of the coming assessment until after the board renewed its contract with a preferred vendor, one that had donated to his last board campaign. Court dockets across South Florida now list dozens of cases pitting residents against their own associations. Plaintiffs allege everything from improper reserve accounting to conflicts of interest in hiring engineers for mandatory SIRS reports. In one case, a Broward judge ordered a temporary injunction after owners produced emails showing a board member lobbying for a contractor, who later landed a $1 million repair deal. The board president, under mounting scrutiny, insists all decisions follow the law and points to the looming state deadlines as justification for moving quickly. But for many owners, trust is gone. At a recent meeting, shouts of recall and audit drowned out attempts to discuss the next assessment schedule. These lawsuits are more than neighborhood squabbles. They threaten to freeze critical repairs and delay insurance renewals, putting entire buildings at risk of noncompliance. Banks have begun to flag properties with ongoing litigation, complicating mortgage approvals and scaring off potential buyers. Realtors now warn clients to review board meeting minutes and pending lawsuits before making any offer. The instability at the heart of many associations is driving even more owners to list their units, hoping to exit before the next round of legal bills or assessments hits. As boardroom turmoil spreads, the promise of condo living, shared risk, shared reward has fractured into suspicion and costly litigation. Just as the mortgage crunch bears down on the rest of the market, mortgage rates near 7% have redrawn the boundaries of who can buy a home in Florida. For the average first-time buyer, the math is no longer abstract. In 2021, a $400,000 home with 20% down and a 3% rate meant a monthly payment of about $1,350 for principal and interest. At today's rates, that same loan costs nearly $1,900 before taxes, insurance, and fees. That's a 40% jump in just 4 years. And it doesn't account for the insurance premiums or HOA dues that now routinely add another $700 to $1,500 a month. Lenders are watching debt-to-income ratios edge past safe limits, even for buyers with solid credit and stable jobs. In Jacksonville, a young couple describes their journey pre-approved at 3%, then watching their buying power shrink with every Fed hike. By the time they found a home, the monthly payment was $500 higher than their original estimate. When the insurance quote landed, their DTI ratio shot above 50%, and the lender withdrew the offer. The deal died in underwriting, and the couple walked away, losing inspection fees, appraisal costs, and months of searching. Appraisal gaps are now the rule rather than the exception, especially in markets where prices have fallen, but sellers cling to last year's values. Buyers in Orlando report appraisals coming in $30,000 below contract, forcing them to either cover the difference in cash or watch the deal collapse. Some try to renegotiate, but with rates pushing monthly payments to new highs, even a price cut rarely makes the numbers work. The result is a market where first-time buyers face a wall of financial barriers. Every percentage point in rate translates to hundreds of dollars lost in affordability. Investors, too, are feeling the squeeze. Rental yields are eroded by higher borrowing costs, and many are rethinking whether to buy at all. In Jacksonville, contract cancellations now approach 20%. a direct reflection of buyers and investors alike, hitting the affordability ceiling. For those hoping to enter the market, the path narrows with every rate hike, and the dream of home ownership slips further out of reach. By late summer 2025, the exodus of investors from Florida's housing market is no longer a rumor. It's a measurable force reshaping entire neighborhoods. Mortgage brokers in Orlando and Jacksonville describe a sharp reversal from just 2 years ago, when institutional buyers outbid families on sight unseen deals. Now those same investors are rushing to unload properties, spooked by mounting losses and unpredictable closing costs. The number of investor-owned listings in major metros has quietly doubled since 2023, according to brokerage tracking, with many owners resigned to selling at a loss to avoid another year of soaring insurance and tax bills. Builders, too, are hitting the brakes. Internal memos from several national home builders reference a pause on new Florida projects until further notice, citing unsold inventory piling up in subdivision after subdivision. Construction sites that once buzzed with activity now sit idle, their shells baking in the sun as crews are reassigned or let go. One mortgage broker in Tampa describes calls from builder partners who have stopped offering rate buy-owns or closing incentives, instead focusing on clearing existing inventory. We're not breaking ground on anything new until we move what's already built. The effect is immediate. MLS data shows a surge in back-and-market listings, many tagged as former rentals or investor flips. In Cape Coral and Fort Lauderdale, agents report entire blocks where half the homes are now vacant or up for sale, often after tenants were asked to leave so the property could be listed. The glut is most visible in neighborhoods that boomed during the pandemic, where investor demand once set the pace and now accelerates the downturn. Mortgage officers warn that the pullback isn't just a blip. Lenders are tightening standards, and buyers, especially those relying on investor capital, find fewer options and less appetite for risk. As builders freeze new projects and investors flee, the supply of available homes continues to outstrip demand, deepening the imbalance. The vacuum left behind is felt not only in unsold homes, but in lost construction jobs, canceled contracts with local suppliers, and the growing sense that Florida's housing market is entering uncharted territory. Cape Coral now stands as the epicenter of Florida's housing unraveling. By August 2025, Totality analysts ranked the city #1 in the nation for risk of further price collapse, a distinction no local official wants. The numbers are relentless. Inventory up more than 35% since last year, median sale prices down nearly 10%, and a growing chorus of agents reporting entire blocks of vacant or unsold homes. For families who bought between 2022 and 2024, the reality is especially grim. Many now owe more on their mortgages than their homes could fetch on the open market. While no official tally is published, real estate economists warn that Cape Coral faces the fastest growing negative equity risk in the country. Brokers describe calls from desperate sellers, some underwater by tens of thousands, hoping for a miracle offer that never comes. Inside the Lee County Administration Building, tension boils over in a hastily called press conference. The governor, flanked by local officials and housing advisors, faces a barrage of questions about failed insurance reforms, the exodus of major carriers, and the mounting wave of contract cancellations. His voice wavers as he reads prepared remarks, pausing more than once to steady his hands on the podium. "We are doing everything in our power to stabilize this market," he insists, but the room is thick with skepticism. A reporter presses for answers about Cape Coral's top risk ranking and the growing number of owners unable to sell or refinance. The governor's composure slips. He glances at his staff, then admits, "We never expected it would get this bad this fast." Brokers in the audience exchange glances. One whispers, "This is the worst I've seen in 30 years." People are losing hope. Outside, a small crowd of homeowners holds up signs with their mortgage balances and insurance bills, pleading for relief that never comes. For Cape Coral, the meltdown is no longer abstract. It's written in every for sale sign, every vacant lot, and in the faces of leaders who have run out of answers. The market's collapse has reached its apex here, not just in numbers, but in the visible strain on the people tasked with holding the system together. Across Florida, nearly 15% of home sales failed to close in the past year, with cancellation rates peaking at 20% in cities like Jacksonville, Orlando, and Fort Lauderdale. The data confirms that soaring insurance premiums, now averaging over $7,500, alongside sharp hikes in homeowners association fees and mortgage rates near 7%, have pushed affordability out of reach for many buyers. Legislative changes following the Surfside collapse led to mandatory reserve studies and assessments up to $80,000 per unit, deepening the strain on condo owners. While reports highlight Cape Coral as the top risk market with growing negative equity, the full impact on long-term property values and migration trends remains unclear. Not all records on insurer withdrawals and homeowners association legal disputes have been released. What is certain, the forces that fueled Florida's pandemic housing boom have reversed, leaving thousands caught between rising costs and falling prices. For now, the state's housing crisis stands as a stark warning documented in contracts, court filings, and the stories of everyday residents.